How does tactical asset allocation work for older investors? Imagine steering a boat through changing waters, adjusting your sails to keep steady and safe. That's similar to how tactical asset allocation works for older investors. It's a way to actively manage your investments, shifting your mix of stocks, bonds, and cash based on current market conditions. Unlike setting a fixed plan and sticking to it, tactical asset allocation lets you respond to economic changes to protect your money and seek growth. For seniors, this approach is especially helpful because it balances the need for income and capital preservation. When markets look risky, tactical strategies often reduce exposure to stocks, which can be more volatile. Instead, they increase holdings in bonds or cash, which tend to be safer. If the economy seems strong and markets are rising, the portfolio might temporarily hold more stocks to take advantage of growth opportunities. But these shifts are usually more cautious than for younger investors, who might take bigger risks for higher returns. The core idea is to watch economic signals, market trends, and valuations closely. If indicators suggest a downturn, the portfolio can be adjusted to lower risk. For example, if economic reports show slowing growth or rising interest rates, a senior investor might cut back on stocks by 10 to 20% and boost bonds by the same amount. These moves are often made within a short time frame, like 3 to 12 months, to stay flexible and respond quickly. Risk management is a big part of tactical asset allocation for older investors. Since they often have less time to recover from losses, the focus is on protecting what they have. This means avoiding large drops in value that could threaten their income or retirement plans. Diversification also plays a role here. By spreading investments across different asset classes, the portfolio can better handle market swings. When one area falls, another might rise, helping to smooth out returns. Another key point is liquidity. Older investors usually need quick access to cash for expenses or emergencies. Tactical moves are often designed to keep enough cash or easily sellable assets available. This way, they can meet immediate needs without having to sell investments at a bad time. In practice, a typical allocation might start with 40% stocks, 50% bonds, and 10% cash. If economic signals turn negative, the investor or advisor might reduce stocks to 25%, increase bonds to 65%, and keep cash steady. When conditions improve, they might increase stocks again, but usually not back to the original higher levels, maintaining a conservative stance. Overall, tactical asset allocation helps older investors stay flexible in a changing market. It's about actively managing risk while still seeking reasonable growth and income. Regular review and adjustments are essential, often with professional guidance, to keep the portfolio aligned with income needs, risk tolerance, and the time remaining before retirement. This approach aims to protect assets and make the most of market opportunities without taking on unnecessary risk.